The aim here is to provide a 45-minute economics taster lesson whereby I will talk to you about the economic problem and link that to financial markets. Just by way of introducing myself, my name is Neil McKenzie, and I have been a teacher of economics at Abbey College since September 2017. Prior to that, I taught at another college, and before teaching, I actually worked in financial markets for 20 years. In addition to my role as an economics teacher, I'm also one of the directors of studies here at Abbey College, Cambridge, where one of my primary responsibilities is to help all year 13 students, whether they are A-level or foundation, with their university application process. So that's enough about me. Let us now begin the economics taster lesson. As I say, if you've got any questions, please tap them into the chat. So hopefully you can see my screen here. And as I said, what I'll be doing is talking to you about the economic problem, an introduction to it, and essentially the role of financial markets. So, what is the study of economics? The study of economics is many things, but it's divided into microeconomics, which looks at issues from an individual's perspective or a firm's perspective or a particular industry. It can also look at environmental issues. And then from a macro perspective, this is where we sort of look at economies, as a whole. So we would look at countries, we would look at, regions, so like, European region, Asian region, and even, world issues. But ultimately, whether you're looking at economics from a micro or a macro level, it is the study of the economic problem. And basically, the economic problem boils down to the fact that we have unlimited wants or needs. And when we talk about wants or needs, wants are obviously things that we desire. Now, in economics, it's not enough just to desire it, you also need to be able to pay for it. But wants are, things that we don't necessarily need to have to survive, while the needs, we need obviously to have these to be able to survive. So when we talk about needs, we typically talk about, everyone needs a shelter, everyone, needs a roof over their head. Everyone needs, food to be able to survive. Everyone needs clothing to, protect themselves from the elements. And arguably, you could include that everyone has the right to a certain level of health and a certain level of education. And, if you ask my children, they would throw in a mobile phone as being a need and not a want. And, there is a debate between what is a want and what is a need. And arguably, these days, you could say the internet is now a need, as, we are now all over the internet. And, here I am able to deliver an online lesson. But the economic problem is that we have unlimited wants and or needs, and the world has scarce resources. So we don't have sufficient resources to meet the unlimited wants and needs. And as a result, we need to make choices as a society how best to allocate these scarce resources to meet the goods and services. Choices need to be made about how we allocate these scarce resources to actually make the goods and services that we want and need. Now, there are different economic systems set up to determine how we allocate these scarce resources. That's not something I'm going to be talking about today, but one of the important things is that to try and solve the economic problem, we need to specialize at what we are best at making to make better use of scarce resources on a global level. So what do I mean by specialization? Now, specialization, if you're talking about a human being, a worker specializing, Adam Smith called that the division of labor, and that's basically where an individual specializes in a certain task or a certain job which they are best at. And by specializing, an individual is able to be more productive and therefore make better use of scarce resources. We can also talk about specialization, on a countrywide basis. And, countries will specialize in making goods and services that the rest of the world, you know, wants. And they will specialize in producing something that they are comparatively better at producing. So, for example, if a country has a large pool of labor, then that country is likely to specialize in producing goods which are labor intensive. Another country might have an abundance of raw materials like oil, like natural gas, like iron ore, coal, things like that. That country then is likely to specialize in producing those raw materials. And equally, you might have a country which has a well-trained, educated workforce, and they will specialize at delivering high-end services like education and finance. But the point is this, is that to deal with the economic problem, we need to specialize to make better use of the scarce resources. But if we specialize, it means we need to be able to trade. So we need to be able to exchange these goods and services, because if we specialize, we're not going to get the range of goods and services that we need, in terms of being able to survive and prosper. So specialization means individuals, and more importantly, countries, need to be able to trade. And if we are trading, unless there is a double coincidence of wants, so double coincidence of wants is one way to trade is to barter. So barter just means that we exchange one good for another good. So for example, if I am a cattle farmer and I want to sell 4 cows, if I can meet another farmer, for example, who sells wheat, and they have, I don't know, let's say 5 tons of wheat, and I'm willing to exchange my cows for that wheat, that is what we call a double coincidence of wants. In the real world, that doesn't happen very often. So therefore, to make trading more efficient, we need money to trade. And this is basically where the role of financial markets steps into economics, so to speak, because you could say that financial markets have developed over time to facilitate trade. So this is to allow people to trade, and it also permits economic agents. So when I say economic agents, I mean individuals, whether they are consumers or whether they're workers. We could talk about firms, producers of goods and services, and we can also talk about government. These are all examples of people or economic agents who are able to use financial markets to manage their money, so manage their savings, and also raise funds for investment. And we'll return to what we mean by investment. It has a specific meaning in economics. So before we go into the sort of role of financial markets, let me just give you a quick overview of the history of financial markets. I'm not going to spend too long on this, but you know, throughout the ages, there has always been some form of a financial market, whether it's not particularly sophisticated or sophisticated. But they have always been there to facilitate trade. And you could say the first genuine stock markets didn't really arrive until the 1500s, but they've always been some form of market where debt was exchanged. So, for example, in France, agricultural debts were exchanged between merchants, and this you could say is the first example of brokerage. And then later on, sort of in the 13th century, Venice and then the surrounding Italian city-states started trading in government securities. So government securities are just basically financial assets that governments issue, and as we'll see, an example of that is bonds or government bonds. But you could argue that the East India Company is widely recognized as one of the world's first publicly traded companies. And really, the reason why it was set up was to deal with risk. Because if you think about it, at the time, you know, the East India Company used to trade, you know, in Asia and all over the world, and then be shipping goods back and forward between Europe and these countries. And the risk was that the cargo would never reach its destination, either because, you know, bad weather or pirates. So it was very risky for an investor to put all their money into one basic, you know, one cargo, one shipment of cargo. So a way was found to mitigate this risk, to decrease this risk, and this was to set up what was known as a publicly traded company based upon the limited liability formula. And the limited liability formula was quite unique at the time, in the sense that before this, if you set up a company and that company was loss making, you were at the risk of losing everything that you owned, you know, all of your assets. With a limited liability formula, this allowed investors to invest in certain ships who were, you know, delivering certain cargoes at different times, in the knowledge that if that voyage was not successful, they would lose only what they put into the company. So their initial investment is the most they could lose. They would not then be exposed to having to lose, you know, their other assets, their house, things like that. So the limited liability formula and the fact that these companies were publicly traded meant that as an investor, you didn't have to put all your eggs in one basket. You could, you know, let's say there was a third of a chance that a shipment would be seized by pirates. The way you could diversify this risk was by purchasing shares in multiple companies. So these are the multiple companies were different, you know, cargo shipments. And even if one ship was lost out of, you know, 3 or 4 shipments or invested companies that the investor had bought, you are still able to make a profit. And this formula, the limited liability publicly traded company, idea was then successfully adopted in other countries throughout the UK, France, Belgium, and the Netherlands. So, before actually there were stock exchanges, there were physical places where people could meet. The first stock exchange, the first place where traders and investors exchanged stocks was in coffee shops. And here they were handwritten on sheets of paper, and investors traded these stocks with other investors in the coffee shops. It soon became apparent that these coffee shops, which were effectively the first stock markets, because that's a place where people could come and buy and sell stocks, people realized that it would be much more efficient to have the entire business focused on a dedicated marketplace where businessmen could trade stocks instead of having to order a coffee and yell across a crowded cafe. So, from these coffee shops came your financial markets, stock exchanges that we are aware of today. So the London Stock Exchange was but was formed in 1801, and it wasn't until 1825 that shares were traded. The New York Stock Exchange, one of the largest in the world, was formed in 1817. Korean Stock Exchange somewhat later in 1956. Hong Kong, dates back to 1866, but only formally became an exchange in 1891. And then another example of a stock exchange would be the Shanghai Stock Exchange, which opened up in 1990. So these are just examples of your modern day stock exchanges and when they were set up. Here's a list of the top 10 stock markets in the world ranked by market capitalization. That just means the value of shares traded on that particular exchange. So here you've got, the ones that I've mentioned already, plus Toronto, Frankfurt, and Australia. So now, having done a little bit of history about financial markets, a brief history albeit, let's look at the role of financial markets. What role do financial markets play in an economy, and how do they help the real economy to grow, and how individuals and firms are also able to use financial markets? So one role of financial markets is it allows economic agents to save. Now, when we talk about saving in economics, we're effectively talking about economic agents putting their excess money, either keeping it in money, so leaving it in the bank, or they might choose instead to buy shares or buy bonds or buy any other assets. That is defined as saving in economics. Now, obviously, if you buy shares, you have the risk that your savings will decrease in value if the shares that you bought obviously decrease. So one important role of financial markets is it allows economic agents to save, which in turn gives banks and financial institutions the ability to lend. And here, and we'll go through this in a little bit more detail shortly, but financial institutions can provide lending to both firms if they want to expand their business, or they might lend to individuals, to consumers, to buy what we call consumer durables, so things like cars, TVs, other what we call white label products. So there's a key role for financial markets in facilitating saving and lending. In addition, they allow us to exchange goods and services. So for example, if I buy something on the internet through Amazon or through whatever other um, internet seller, I can pay by credit card, and I will get the good in next day or the day after. So financial institutions allow for the payment of goods and services to be processed. And they also provide a market for equities and bonds. I'll explain what these are shortly. They provide insurance markets. So here we're talking about all kinds of insurance, in the sense that it could be a household insuring against a fire, against a theft. It could be a business insuring against, flooding or any other natural disasters. Or even, I suppose, if some businesses had the foresight, they could have insured against, a pandemic. But financial markets are key in providing insurance facilities. And then finally, and I'm not sure we'll have time to go into this in great detail, they provide a forward market. And all we mean by a forward market is financial markets provide a platform, a market, whereby people, firms, banks can buy and sell assets for future delivery at some future location in terms agreed upon now. But that topic, forward markets and derivatives, is, you could do a whole separate series of lessons on that. So in terms of who are the participants in financial markets, the most obvious are obviously banks. And when we talk about banks, we generally divide them into retail banks. So these are institutions which provide banking services to households, to individuals. So, for example, when I get paid, the money goes into my current account. So individuals, when they get paid, retail banks will handle their wages and salaries. But retail banks also provide other types of facilities to individuals and very small businesses. They provide, savings account, overdraft facilities, mortgages. Anyone who has a mortgage, whereby a mortgage is effectively someone taking out a loan to buy a house. You also have commercial banks, and they provide a variety of services to businesses, and they tend to be more larger businesses, small and medium enterprises. But they provide banking services to businesses, but they will also lend to businesses. They will handle payments on behalf of businesses, both for their customers and suppliers. And then finally, you have investment banks. And investment banks provide a variety of services to both international corporations, but also high net worth individuals, whereby they will provide trading services in a variety of assets. So this could be, in equity, in bonds, and other types of assets. They provide foreign exchange, currency services. They provide advice on mergers and acquisitions. Your typical examples of your big investment banks are JP Morgan and Goldman Sachs. While with commercial banks, it could be HSBC, Barclays, and for retail banks, it could be in the UK anyway, NatWest, Santander as examples. One thing to be very clear of is that it is possible for one institution, one entity, to be all three together. So it could be a retail bank, it could be a commercial bank, and it could be an investment bank. So an example of that here in the UK would be Barclays. It provides all three kind of services, as does HSBC. Other types of financial markets participants are essentially what we call savings vehicles. So these are pension funds. These are funds who are set up to manage the savings for those, retirement savings for those who have pensions. You have private equity. So basically, private equity firms are firms who look to buy companies which either have bad management or have something slightly sort of, shall we say, inefficient with them. And these private equity funds will buy that company. Normally they take it private. They then turn it around. They do whatever management changes they need to do. They do whatever changes they need to do to the process of running the company. And then once they've turned it around, they will then make it public again. So that means selling it again on the stock market, and that way make a profit. Another savings vehicle is a hedge fund. And essentially, a hedge fund is just a fancy name for a limited liability partnership which seeks to make money by trading in different types of financial products. And then other participants in financial markets are obviously insurance companies, who both buy and sell insurance for, as I've already mentioned, for a variety of scenarios. Governments are also actively involved in financial markets, because if governments are spending more money than they are receiving in taxation, which would certainly be the case in a pandemic like we're in right now, they need to be able to borrow this money. And as we'll see shortly when we look at bonds, one way they're able to do this is by selling bonds. And then finally, central banks are big participants in financial markets, certainly in domestic financial markets, because they aim to obviously try and influence the economy through the variety of different policy tools that they have. We should also make the distinction between a speculator versus a hedger. A speculator is an individual or company who's basically seeking to profit from changes in the price of different assets. So if I think a particular share, I don't know, let's say IBM is going to increase in value, then I will buy it now, and hopefully I'm right. And when the share increases in value, I will then sell it and make a profit by buying cheap, selling expensive. And equally, they could do the opposite. They could, if they think something's going to decrease in value, they could sell it and then buy it back cheaper. But speculators are essentially participants in financial markets who are looking to profit from price swings. Hedgers, on the other hand, are in financial markets to get rid of price risk. So they're looking to get rid of exposure to a particular asset. So, for example, if I am a farmer of wheat and I've planted my crop and the crop is not going to be harvested until 6 months' time. I don't know what the price of corn will be in 6 months' time, but I can go into financial markets and hedge my exposure by selling my stock now, so I know what price. Sorry, I'm selling my crop now, so I know what price I will get. So you can think about it. Hedgers are looking to decrease risk, whilst, sorry, someone's raised their hands here.
Hi, now. Sorry to interrupt. This is Yuki. I'm the sales staff in looking after UK-based agent. We have an agent and wants to join in and waiting for your approval.
I can't see it. Let me just see. What's the name? Sorry.
Diana?
Sorry, let me just stop sharing for a second. Apologies. And let me just see if I can allow them. Sorry about this.
Thank you now.
Sorry if I'm particularly close now while I'm leaning into my screen. I can't see anyone that I need to add. I'm really sorry.
Okay, that's no worries. Probably she by some reason she logged off. I let her to join back in again, and then if you see.
Yeah, if you ask her to join back in again, then hopefully I can then add her. Oh wait, hang on. No, I can't see it. But if you ask her to join in again, I'll try and add.
Thank you very much. Sorry, everyone.
It's okay. Sorry. So going back to sharing my screen here. So now we've just distinguished between speculators and hedgers. Speculators want to take on risk, while hedgers want to reduce risk. And then we should also distinguish between brokers and market makers. So brokers basically don't trade for themselves. They act on behalf of clients, whilst market makers trade for themselves, and their main role is to provide what we call liquidity to a market. So what we mean by liquidity is just how easy it is for someone or for an institution to buy or sell a stock and get in and out of a position. So if a market is very liquid, then it is easy to buy and sell. If it is illiquid, it is much more difficult to buy and sell. So remember we said one of the functions of financial market was providing a platform whereby economic agents such as firms and businesses can get money to invest. How do firms get money to invest? Well, first of all, we should, as we'll see with economics, right? Economics, when at least people are starting it, it's key to have some clear definitions and to know those definitions, because then that forms the basis with which the knowledge can be acquired, and then the high level skills of analysis and evaluation can be used. But when we talk about, yeah, I've just added someone now. When we talk about investment in economics, we specifically mean, and I'll give you the definition, investment is the purchase of capital goods by firms. So, sort of to put it in more layman terms, investment is when firms buy more machinery, buy a new office, expand their business. That's what we talk about investment. When individuals buy shares, as I mentioned earlier on in this lesson, when they buy shares or buy other financial assets, they are effectively saving. So, in business, for example, when people invest, we typically mean they're buying and selling shares. But in economics, we have a specific meaning, which is when firms buy capital goods, and capital goods are just man-made aids to production. So I'm just conscious of the time here. So how do firms get money to invest? Well, they may have their own funds. So over time, they have made profit. They have kept some of that profit. They haven't paid it out. They've kept it. So if they want to expand their business, they could use their own funds. Alternatively, they could borrow the money from a bank. So this is essentially where a business will go to a bank and get a loan. And that loan will be granted by the bank based upon them, looking at the risks and deciding whether it was worth it or not. And then the loan would have an amount that you borrow, when you have to pay it back, and an interest rate that you have to pay the bank. An alternative way for firms to get money to invest is what we call equity financing. And with equity financing, all that means is a company is selling shares on a stock exchange to the public, and from the money from the shares, they can then use that for investment purposes. And then an alternative way of raising money is what we call bond financing. And I will explain the difference between bonds and equities shortly, but bond financing is essentially another way for a firm, corporation, to borrow money to invest. I won't go through the factors that affect investment in great detail, but firms will only invest if they're confident about the future. If interest rates are low, it's more likely to encourage them to invest. If the economy is growing, they're more likely to invest. But there is a multitude of factors which affect investment. I won't go through these here. So when we are talking about financial markets, there are different, shall we say, subsets of markets within the financial sphere. So the ones that we will look at here are money markets, capital markets, foreign exchange markets, commodity markets, and very briefly, we'll look at insurance markets. I don't think we're going to have time to look at derivative markets, because as I said, that could be a whole separate series of lessons. So when we talk about money markets, these are essentially short term. So these are markets for borrowing and lending funds for less than 1 year. So up to 1 year. So it's short term borrowing and lending. And there are various economic agents that can operate in money markets. You can have governments. So the UK governments might borrow short term by selling treasury bills. So they're essentially repayable after 91 days. And you also have commercial bills of exchange. So this is a way for companies to borrow. And essentially all bills of exchange are that they're promises by companies to pay for goods and services at some fixed point in the future. And these can then be sold, these can be traded by firms that have already delivered the goods, but want to get the money immediately instead of waiting for a month, 2 months, 3 months. And a very important section of money markets is what we call the interbank market. And essentially the interbank market, we'll put it this way, at the end of each day, banks are either going to have a surplus of funds or a deficit of funds. So a bank will have a surplus of funds if they've received more deposits that day than withdrawals. Equally, on another bank on that same day might have had more withdrawals than deposits. So at the end of the day, these banks will go to the interbank market and borrow and lend money from each other to effectively balance their books. So the bank which has surplus funds will lend money in the interbank market to the bank that has deficit funds. And obviously each day, and they will do this for it could be for as little as overnight, 1 week, 1 month, 3 months, as long as it's short or less than 1 year to be classified as being in the money markets. Capital markets, on the other hand, are there to provide long-term financing. And here we're talking about bonds and equities. So a bond is essentially an IOU. And let me just try and share my screen. I'm going to try and share my other screen where I can sort of draw what I'm planning to explain. So if I now share, sorry, bear with me here. So for some reason I can't share the screen. Oh, I can actually. So bonds, the way to think about bonds is that they are an IOU. So for example, let's say I'm the government and I want to borrow £100, right? This is what we call the principal amount. So this is the amount that the government is looking to borrow. So bonds essentially have 3 characteristics. One is the principal amount, so that's the amount that's being borrowed. Secondly, there will be the coupon or the rate of interest that the government in this instance will pay to whoever's bought the bond. So let's say that's 5%. Then thirdly, another characteristics of a bond is you have what is known as a maturity. So e.g. 5 years. So basically the maturity date is the date at which the bond the principal amount, this £100 will be paid back. So let's say in our example here, you have a government who wants to borrow £100, so they are going to sell a bond with a principal amount of £100, and it's going to have a coupon rate of 5%, and it will be repaid in 5 years. So on day one, and let's say you've got an investor here, on day one, a bond with a principal amount of £100 will go from the government to the investor, and then in exchange the investor will lend the government £100. Now let's say this investor decides to keep the bond and they don't do anything and they just hold it. Then at the end of year one, the investor will get the £5 interest, the coupon. End of year two, they will get another £5. And on you go to end of year 5, whereby the government repays the £100 plus the last final £5 in interest. So over the 5 years, the investor has earned £25 in interest payments. Obviously, this is excluding compounding, etc. But this is essentially how bond markets work. So on day one, and we've got to distinguish between day one, which is what we call the primary market, and then the secondary market, whereby this investor could then sell these bonds to other investors. So let me stop sharing that and go back to my PowerPoint, and I'm conscious of the time, so I will try and wrap up as soon as possible. So there's time for questions. So bonds are basically IOUs, pieces of paper, which obviously they're not pieces of paper these days, but they can be traded electronically, and both governments and firms can use them to raise money. So, and they are traded both in the primary market and the secondary market. The primary market is just the market when the bonds are first sold. Thereafter, they can be bought and sold by anyone in the secondary market. And equities are different from bonds in that equities are shares which give you an ownership right, part ownership in the company. So when you buy shares, you are hoping you're now a part owner of the company, and your reward will be in terms of dividends. So this is a share of the profits that the company will pay to all shareholders, but also you will hope that the share will increase in value. Once again, they're different from bonds in that bonds, you get paid back the amount that you lent the government or the company when they mature. With equities, they never mature, and you can sell them to someone else, but you'll never get all the money back that you purchased from the company. And basically, most trading in bonds and equities is speculative. So that means it's people buying and selling shares and bonds because they think they're either going to go up in value or decrease in value. Less than 1% is related to new borrowing or raising new finance. So I've already explained bonds and equities. It's probably I haven't quite finished all the financial markets that I would have wanted to do, but I think it's probably now worthwhile me um, opening the floor to any questions that you might have, and or any comments that you might have. If you can put it in the chat. I don't see any questions, so I'm assuming that's because either I've explained it so clearly that there are no questions, or you've all switched off. No, I'm hopefully joking on that.
I know, and I think it's great, and I think it's our first session, and most people are quite new to that kind of settings, and yeah, I think it's great, and we will collect any questions later on, and if there are specific questions about the topic today, and well, I will pass on to you if it's okay.
No, of course, yes. I mean, I hope you found this useful. And yes, by all means, if there are any questions relating to the specific topic I went through, I'm more than happy to address them.
Yeah, thank you. Thank you. I think it's great. And we have a taste session today about economics and how it will be looking like as our students are learning in Cambridge.
Yes.
So
I mean, I'd
that's
just like
really
to
nice.
say this is only a small part of economics. There's a lot more economics, but hopefully you get an idea of what Abbey students will learn when they study economics with us.
Yes, yes, that's really nice. And for everyone else, we have more sessions coming up. And yes, please take a look and pay attention to your emails. And or you, if you have any questions, please ask your regional sales manager, and we can pass on all the details to you in regarding future sessions. Thank you very much, and thank you, Neil.
Thank you. Thank you. Bye, everyone. Have a good day. Bye.
Bye. You too. Bye bye.